Well, hey there, everyone. Happy Monday, June 23rd, 2025. Welcome to Chart This with Dave Keller. I'm your host, Dave Keller, back here better than ever in Redmond, Washington. Happy to be safely home after a fantastic week at music camp. Wish I could spend a whole episode telling you about all the things that I learned in musical moments that I had, but just rest assured it was a lot of fun. Great creative week with some really brilliant musicians, incredibly talented professionals and semi-professionals and aspiring amateurs, all just making a joyful noise and having fun and talking music. It was just an absolute blast. Had one of those experiences on the way home. We were about 4 hours delayed. We had someone who had a little too much pregame celebration in the airport at Boston Logan. Ended up being pulled off the plane. It might be on social media somewhere because it was a whole thing. Had a sweep of the airplane. It was next level. So the bad news was it was pretty disruptive. The good news was we got home safely. Quick rooster update. They're gone. We were all gone last week. We had someone watching the house. They did have instructions to feed the roosters. They did put the food out. After a couple of days, they disappeared. I don't know if it was a bobcat or cougar issue, if they found another home, but I hope they're somewhere safe and happy wherever they're at. But we have not seen them since we've arrived back here in Redmond. So I'll keep you updated if that changes. With that in mind, let's talk markets here. Obviously, so top of mind, on the news side is obviously the events in the Middle East escalating very rapidly. And one of the things we talked about was, when people talk about potential impact of military, action somewhere in the world, the question always is, does it threaten some sort of big economic forces, right? So I guess the general observation I would say is, for now, there hasn't been a ton of an impact on the markets, and arguably today the markets were relatively strong here in the U.S. because this weekend could have been way more, it could have gotten way uglier. Obviously the U.S. getting directly involved here kind of changes the game in probably not so subtle ways. I think that's something we'll probably be dealing with for many, many years going forward. For now, though, the reaction has been relatively limited. It's been measured. The Strait of Hormuz, which is where a lot of oil is, a big traffic for oil, has not been, shut down or disrupted really. So while there could have been much more significant disruptions to a lot of things, it has been muted. However, can't stress enough, that is a volatile situation. The impact, I don't know if we've really felt it yet. That's the kind of thing that we'll see over time. So it ends up being one more sort of factor to consider. What you'll see is that here today is that the energy sector ended up being the weakest by far. Crude oil prices plunging, and that's basically because there could have been a much more significant reaction that ended up being very negative for oil supply, probably, and jacking up oil prices. But that really didn't happen. There really hasn't been any major significant disruption to crude oil. As a result, prices coming down pretty big, and so that's meaning the energy sector has come down. Again, the market is pricing in what it's seeing and hearing at this moment. This can change in an hour if some new attack occurs, if someone else gets involved. It's just an unknown. So I would say, in terms of what I'm seeing now, the markets are pricing in limited disruption, limited impact. We'll see if that actually plays out. All right, enough of an intro. Let's talk about the charts and how they're playing out. If you're new to the show, I appreciate last week if you did tune in and followed my random musings when I could grab time in a practice room to share some thoughts with you. But good to be back in the home office here, sharing some observations. And let's look at the chart here. So the S&P did finish higher today. Friday, remember we had Juneteenth on Thursday, so no market activity. Friday reopened, kind of a weaker day, finishing lower. News of the U.S. getting involved in the Middle East more directly coming out on Saturday. Sunday, we get some reaction and obviously some continued escalation there. But it has not gotten significantly worse for now. As a result, the S&P sort of pushing higher through the course of the day. Big sell-off around lunchtime that did take the S&P briefly negative, but a nice rally in the afternoon. S&P did close back above 6,000. That's one of those big round numbers I think is going to be important to monitor to see if that ends up holding. For now it certainly is. So the S&P about 1% higher. Mid caps and small caps all up about the same. The small cap index was the best performer, up about 1.2%. The Dow, the Nasdaq, I mean, all these indexes about the same, about 1% up for the day. VIX moving back lower, so the VIX is back below 20. That's kind of our main threshold, separating a high volatility, a low volatility environment. A little more nuance, I'm sure we can apply to the chart of the VIX, and I think I grabbed that chart to look at in a bit. But I would say, VIX back below 20, good sign for risk assets, basically saying volatility is relatively low. And again, the fact that there is a brewing and escalating situation in the Middle East now, with the U.S. as a direct actor in that event, I consider me surprised that the markets have not taken on a little more of a volatile, risk-averse kind of move. They're actually doing just fine there. Again, basically, the market is saying this is going to be limited disruption. Interest rates generally moving lower. Bonds did move slightly higher. The TLT finished up 0.3%. It was up a lot more around lunchtime, but then afternoon Eastern time, bonds have rolled off a little bit, but it was enough for rates to come down here. So the 10-year yield down around 4.3%. Long bond yield right around 485. The 5-year point now down below 3.9%. So we've seen this trend in lower rates. The chart of the 10-year yield has really been going down over the last 4 weeks. And so rates getting lower, basically. And that is going through last week's Fed meeting. No change, but now a lot of speculation about where that first Fed cut could come. Really, the next Fed cut could come as early as the September meeting, most likely. Dollar index slightly lower to report there. Commodities, where you see a good amount of action. Now, gold and silver higher today. The GLD and the SLV were both in the positive. Gold finished up about 0.33%. Copper prices were higher, but the big move you have at this point were energy prices, all moving lower significantly. And my read on this is basically that they're with the situation in the Middle East escalating, it could be very destructive. There could be a lot of attacks on oil refineries, kind of things that would directly disrupt the source of oil or the supply of oil, that would generally cause prices to go up very, very quickly. We really haven't had that. Attacks have been more focused in things that are not oil related from my take. Events that could have been disruptive have not happened. And so as a result, the market's basically saying that crude oil prices don't appear to have a big upside move. Usually you expect crude oil prices to spike. We've been seeing that trend higher in crude oil prices, into today. But today, oil down, energy stocks down pretty significantly as a result, which makes sense. Finally, looking at cryptocurrencies, you can see Bitcoin actually briefly went below 100,000 in the last 24 hours. Here's Sunday into early hours, Monday Eastern time, and then the rally through the course of the equity trading session. Bitcoin's basically trading at the highs of the last 24 hours, around 104,000. But you can see, again, we're kind of testing big round number support here, right around 100,000. I would say, not surprisingly, you're finding that for now serving as a sort of a short-term floor. So thinking of this with like a swing trading perspective, that kind of 100,000 level seems like a decent, place where you probably not expect it to go a lot lower than that, barring some huge risk off move where people are selling all sorts of risk assets, and Bitcoin and Ethereum and others kind of get dragged down with those. But for now, nice uptrend through the course of the equity session for the big cryptos, particularly Bitcoin and Ethereum. You can see by the end of the day on the sector side, pretty strong here, right? I mean, you can see the 10 out of the 11 sectors up. So energy was down 2.5%. That's the worst performer, the XLE. Everything else positive. So the XLY up 2%. That's the best performer. Tesla getting a really nice upswing today. I didn't see where it closed, but we'll look at that here on the heat map in a moment. But the robo-taxi rollout in Austin, Texas, if I remember right, or Houston, one of those big Texas cities, going particularly well. So, now a lot of discussion about Tesla versus Waymo and who kind of wins the, robo-taxi race. Real estate, number 2, the XLRE up 1.5%. Industrials, number 3. Up 1.4%. Now, energy, of course, the big downside outlier. Healthcare slightly positive. Materials up about 1.1%, kind of tied with technology. So technology really not a great day on a relative basis. Not bad, but sort of a decent upswing. Just updating my market trend model, no change on Friday, even though the markets have been a little weaker here last week. Not enough. And really the weakness, as we reported on Friday's show and really through the course of last week, the weakness we've seen has been less in terms of price action, more in terms of conditions of breadth and momentum and volume. Those are the three areas where we've seen quite a bit of weakness, particularly last week. So the market has been drifting higher in June, but key measures of breadth, momentum, and volume, none of those have been particularly strong. On some individual stocks, they've been fine, to be clear, but on the major averages, you're seeing the market moving higher on weaker breadth, on weaker momentum, on weaker volume. And so that kind of trifecta suggests to us to be very skeptical of the recent upswing. This market trend model does not, have any sort of input based on breadth, momentum, or volume. It's based purely on price action. And that's why I think it's helpful to look at the market trend model, in this case, bullish on all timeframes for the S&P as of last Friday, which is when I lock in the most recent reading. So the trend, the price is still quite strong. The weakness that we're seeing is another thing. So now that we're seeing weakness in those other things, this is where I start to look to see if and when the short-term model would turn bearish, which would, at this point, earliest that can happen would be this coming Friday, the 27th. So if that would happen, that would be a sign that we're starting to see some negative follow through in reaction to some of the negative rotations we've seen in terms of breadth and momentum and volume. For now, trends still positive on the S&P, on the NASDAQ. Market trend model still bullish on all time frames. Breadth, while it was quite negative last week, pretty decent today. The NASDAQ composite breadth was a little more neutral, but you can see by the color-coded green here for the advanced decline data, pretty decent. The S&P, about a 4-to-1 ratio of stocks up versus down, about a 2-to-1 ratio on the New York Composite Index. So overall, pretty decent breadth today. Looking at the Magnificent Seven and friends, we can see Tesla, as I mentioned, pretty good news about this expected rollout of robo-taxi services and eventually around the U.S. For now, Tesla positive over 8% today. Meta up over 2%, 2.4% for Meta. Netflix and Microsoft both up about 1.8%. Chart of Microsoft just keeps looking pretty great. I mean, right? Keeps making higher highs every week. You would not know, looking at the chart of Microsoft, that there are conditions that are concerning around us as investors. Seems like kind of situation normal all as well. Alphabet and Amazon, the two names in this group of Megacap leadership names in the red. We will look at the chart of Alphabet here because it's testing that 200-day moving average and not doing particularly well in that test. So we'll get to that in a moment. As a reminder, I can see you guys putting in questions on any of the platforms upon which we're streaming: Facebook, LinkedIn, YouTube, and X. We will absolutely gladly accept any super chats you drop on our YouTube channel. And Larry, I want to thank you so much right at the beginning of the episode, putting in a very nice super chat and a nice comment. I can't tell you how much I appreciate that. It's a very, very kind gesture. I'm so thankful that the content we put out has been helpful for you guys. And I appreciate your thoughtful questions and comments, keeping the show pretty active here during the live stream. So thanks so much. I really appreciate that. Very, very kind. So as a reminder, I can't see questions on any of those platforms. As you're watching, as I'm showing charts, talking about particular tickers or themes, drop a question on any of those platforms during the live stream. At the end of the episode, we'll take a question or two. Anything we don't get to, we will put in the mailbag. We had a really good mailbag episode on Friday with some really good questions. So if you missed that one, make sure you check it out. Some really interesting questions asked about a number of different technical indicators and different ways of thinking about the markets in this particular environment. And also a just little brief, maybe not so brief answer to applying mindfulness to the markets, which was a perfect question to answer toward the end of the retreat I was in New Hampshire. All right, let's continue on here with the heat map and see how things are playing out. Here's Tesla with a really strong day today, up over 8%. Certainly the strongest name out of the mega cap leadership names. But I'm also noting, obviously, Meta and Microsoft having pretty strong days as well. Other themes to kind of jump in on. Here's the energy sector looking particularly weak. Now, again, these particular names, these are the S&P 500 energy names, and you can see some of these ones that are more pipeline names, right? Like Williams, WMB, still looking quite good, right? And so there's a there are a number of different types of companies represented in the energy sector. More natural gas, kind of what we call energy infrastructure names, from a technical perspective, have been looking much stronger for quite some time. That's not relatively new. That's actually been the case for a while. You can see the chart of Williams, just this little preview chart, pretty decent. But it's the other names which are more directly tied to the price of crude oil, right? Things like Williams aren't really as vulnerable based on crude oil prices. It's kind of a different thing. But like ConocoPhillips, you're basically betting on crude oil prices. So if you're buying Conoco, you're betting on crude oil prices to go up. And so when crude oil prices take a bath like they did today, coming out of the news-filled weekend about the growing conflict in the Middle East, these stocks are going to be down. Pretty good. I think it's way too early to be clear to say that crude oil prices are not going to spike at some point because of something that happens in the Middle East. Here we're seeing what happens when there's maybe a fear that something happens to crude oil supply. It doesn't happen. And so as a result, prices drop because it's thinking, all right, supply is not going to be disrupted. But now this shows you what's going to happen if supplies are disruptive. And all of a sudden, it's just going to take one news headline talking about how oil of some sort is targeted, or something, Strait of Hormuz is closed or attempted to be closed, something that might disrupt things. Oil can shoot right up just as easily. So I think we're seeing an instant reaction to the news not being as bad for oil as it could have been. Keep in mind that volatility is going to work both ways. So a different headline on a different day is going to cause those stocks to go higher. And the reason why I'm pointing that out is I would be prepared for the XLE to probably be a pretty volatile area of the markets here for the foreseeable future. And so I'm not too married to the fact that this sector is going to work or not work based on one day. It seems like a crazy drop in oil prices for the potential for volatility in that region in the weeks and maybe the months and hopefully not, but maybe the years to come. We'll see what happens here, but that's certainly going to be a hot button area of the heat map to focus on. Let's look elsewhere a little bit here. I would say, definitely noticing with rates coming down, you're seeing some of the home builders start to rally. Now, I will tell you, charts like NVR or Pulte Homes or Lennar or DR Horton, these are not great charts. Okay, so to be clear, I do not see these as great charts. They're probably not horrible charts anymore, right? Horrible charts are where you have a clear downtrend phase. We're below two downward sloping moving averages. We're making lower lows and lower highs. The RSI is not even getting above 50 here for months on end. That is a bearish chart. That is a clearly bearish chart in a distribution phase. Now, I would say charts like DHI are in more of a consolidation phase, right? They're not really making new lows. The lowest low we've had here was here in April. From there, we're actually making higher lows in early June and again in mid-June. Now we're bouncing off of those lows, but we're really not in any sort of clear uptrend, right? The momentum is still neutral. We're kind of bouncing between 40 and 60 now, and really not powering above 60. If that would happen, right? If we break above 130 for the price of DHI, if the RSI would push above 60, the relative strength improves. I would argue that really starts to look like a more constructive chart. So if you're more aggressive and you're kind of more of a contrarian, you're probably buying in this area and betting on an upside reaction and betting on people like me to believe a little bit later. I'm not convinced yet in terms of the upside momentum. I would need to see a little bit more there. This kind of chart is going to work, and the other home builders are going to work if interest rates remain low. And in a moment, we'll look at the chart review portion. I'll show you the chart of the 10-year yield and how rates have come down. Interest rates coming down basically means houses are getting cheaper to buy. Basically, your mortgage is going to be lower if rates continue to go down, and that's why there's a lot of green on the home builder stocks right about now. As usual, we're seeing the technology sector. While the XLK was one of the worst performing sectors out of the 11 today. Here's IBM making new all-time highs today, right? We're pushing $290 a share on the stock on an adjusted basis. Pretty good uptrend. And I would say charts like IBM, charts like Microsoft are strong charts. They're in primary uptrends. They're above two upward sloping moving averages. I would have no problem. I would have no issue with owning names like IBM in a portfolio. I don't directly own IBM, but charts like this kind of make sense because they're in clear uptrend phases. Remember that whatever you're worried about, whatever you're concerned about, whether you're bullish or bearish, or you think whatever macro themes are going to happen, charts like IBM are just good charts, right? I sign off the show every day saying it's always a good time to own good charts. Charts like an IBM right now are the kind of ones that are in the back of my head. Those kind of up and to the right, long and strong types of charts just starting to work. Final observation, then we'll get back. I would say within the industrial sector is actually kind of mixed today. Overall, okay, but I would say there are a number of charts starting to kind of work in here. Some charts that have not been good for a while, and I'm looking like trucking companies in particular. I'm looking at ODFL and JB Hunt. I think it's similar to that previous chart we're looking at. We're sort of like not like Homebuilders, right? It's like they're not great charts yet. They're not bad charts anymore. They're kind of stabilizing. I think the bull case here for equities involves like JB Hunt types of charts starting to work, right? Which means, things I would be looking for would be like JB Hunt pushing above 150. Ideally, right? Even better, getting above the 200-day moving average. So many charts like this that are just not great charts yet, and they're just still underwater relative to the 200-day. They're maybe making a higher low in May into June, but not enough that, it's still sort of in this sort of consolidation, neutral momentum kind of look, as opposed to an IBM, which is like in a primary uptrend. There aren't enough primary uptrends out there in the equity space. So I would say as a kind of bottom-up investor, I'm still skeptical of a broader advance in stocks until you would see some of those names starting to work a lot more. I think that's it for here. But I'm also looking at financials. A lot of the payment processors we highlighted at the end of last week, PayPal, Visa, MasterCard, all pulling back last week. Part of that was the stablecoin announcement that was getting approved. And again, it's just something that could threaten the business of a payment processor today, bouncing back higher. I think those are still red flag kind of charts because of the significance of the pullback we've had off of the highs earlier in June, but certainly an area of the market to watch. All right, we're going to get to the chart review here in a moment. I do want to let you know, by the way, Seeking Alpha has been a longtime supporter of the channel. Really appreciate their support. They've been great partners over time for Market Misbehavior. They do have a summer sale going on right now. If you use my link, which is marketmisbehavior.com/seeking alpha, you can get a special deal. They're offering 20% off all of their products basically right now. Their premium product, their pro level, the alpha picks, all of those things. Premium is the link that I have you pointing to. If you go to marketmisbehavior.com marketmisbehavior.com/seeking alpha, or scan the QR code on the live stream. You can check out all the information on it. As part of it, you'll get a 7-day free trial. And also they're doing a second half of 2025 market outlook featuring Steve Kress, who I've gotten to know and have interviewed for my podcast. He runs the quantitative research department there. I think their quant model is very well done. I love how they are offering that sort of capability to individual investors that use their platform. I would encourage you to check it out. And if you do follow through with that, helps me make Market Misbehavior awesome, gives you a little better deal. It's kind of a win-win. So go to marketmisbehavior.com/seeking alpha for more info on their special summer sale. All right, let's look at some charts together, shall we? Here's the kind of upside bounce. It's not a bullish engulfing pattern because we had a higher open, but it's kind of similar. It's in the same family. It's in the same ballpark as a bullish engulfing pattern, although it technically is not on the S&P. It may be on like the futures and other things. I didn't really look, but it's certainly a nice upside bounce. Friday finished in a position of weakness. 3 out of the last 4 trading days last week, and 4 out of the last 5 trading days had been closes near the lows of the day. So we've had sort of a lack of buying power kind of experience here over the last week. Today, a nice upside follow through, bouncing off of Friday's weakness. We did push back above 6,000. So my immediate question going into tomorrow, does that hold, right? Do we hold that level? We've basically been trading around that level for the last 2 weeks. The market basically rallied up to S&P 6,000 and now is stalled out. We want to see follow through. And I would say if you're on the bullish side, you want to see follow through on stronger momentum. That's crucial because what's happened is A lot of charts I'm looking at that are sort of macro charts have this feature, which is a bearish momentum divergence, higher prices on weaker momentum. That is not a good sign, right? That basically suggests that underneath the hood, the momentum is not as strong as we want it to be. The way you get out of this is on the bullish side is the market rallies on stronger momentum. We need a breakout above 60.50. We need the RSI to continue to improve. We need to get up to the overbought region, which would negate that divergence and suggest a new wave of buyers are coming in. But if that doesn't happen, that suggests that the weakness is more the rule of the day. Let's keep an eye on this and see if there's upside. I think there's plenty of room to have a pullback down to the 200-day moving average and still be within a primary uptrend. We'll see, and that's where I would look for on any sort of downside move. We've highlighted recently the fact that the volume has been less ideal here, particularly in the month of June. This is the Chaikin money flow that we're looking at, which is looking at trends in volume over time based on the work of Mark Chaikin. I think it's a great way of just instead of looking at just a day-to-day volume reading, looking at the trend in volume. But here we're color coding the volume. Black, this kind of grayish color are up closes, red are down closes. And if you just look briefly over the last month, there's been the big volume days have been down days, right? So we've had heavier volume on the down days, which just implies that generally speaking, there's more distribution than accumulation. The Chaikin money flow did go below zero last week. Today, with the bounce higher on decent volume, you're actually seeing the Chaikin money flow push net positive. I think this could be an important chart to watch to see if the volume can stabilize above the zero level. More green, the better on that particular chart. We'll see. For one day, good start. Last week, the name exposure index, it was reported a little late on the stock charts platform because the Juneteenth holiday happened right on Thursday. So it didn't come out till Friday, but it did come in at a 94%. That's above where it was the week prior, which is around 82%, which tells you that money managers in this survey have added exposure or have now gone to overweight stocks more than normal. This is the National Association of Active Investment Managers. So it's money managers that reply in a regular survey, and it's gone positive, right? It's actually increased, and so I think that's encouraging. The sign that money managers, at least in this survey, are stepping on the gas a little bit and starting to believe in further upside. We'll see what happens at this week's report, but last week actually came in a little higher than expected. Here's the chart of crude oil. This is the crude oil contract that we're looking at here. Obviously, a big down day with crude down about 9%. Looking at the future that we track here on stock charts, I did want to point out a couple things. Crude oil was overbought until today, and today's drop actually pulls crude oil out of the overbought condition. So the RSI popped below 70, which basically says we're now in a pullback of sorts. If you take the May low, which is around $56 a barrel and change, you take the high from last week, which was around $76 a barrel, 38.2% of the way down is almost exactly at the 200-day moving average, right at 68.50. That did not hold today. We actually closed below it. So when you have a move like that, tomorrow is key. Tomorrow is follow-through day. And if we see further movement to the downside, that would be a very, very bearish sign for the chart of crude oil, because it says we've had a breakdown of support and we've gone even further. But watch for a whipsaw tomorrow. And I would say the bull case for crude oil, right, would be a bounce back above 68.50, 69, get back above the 200-day, get back above that first Fibonacci resistance level, and see if we're able to regain that threshold. So 68.50, right around that level, I think that's a key pivot point for crude oil. If it can get back above there tomorrow, I think that might actually mean a decent amount for energy stocks, which have obviously pulled back quite a bit today. All right, looking at interest rates, we can see $TNX, which is the U.S. Treasury yield, 10-year U.S. Treasury yield. Here's the downtrend in rates. We talked about the chart of Homebuilders. Names like D.R. Horton, still not great charts yet, but starting to show signs of an upside reversal. That's really driven in no small part because of lower rates, right? When rates get lower, that means your mortgage is probably going to be lower, which means it's easier to buy a house. It's easier to buy a bigger house. That's all good for home builders, whose job it is to get people to buy houses and rebuild them. as a result, this is a trend that I think for home builders has been very, very strong. Here's the kicker: is we're at the 200-day moving average, right? 10-year Treasury yield, the 200-day is right around 4.3%. You can see that here, the red line starting to incline. We're kind of right there. So the question is, does that 200-day moving average hold? Rates have come down quite a bit. The 10-year yield was just about 4.6%. We're now down to around 4.3%. At the bond market close. Lower rates from here are certainly a possibility, and I would say, what technically drives rates lower would be buying bonds, right, or someone buying a lot of Treasury bonds, because that's what's going to cause yields to go lower. If conditions start to deteriorate, if the U.S. involvement in the Middle East starts to worry investors for whatever reason, you probably see that reflected in Treasury bonds. You'd probably see that reflected in rates coming down even further. I think that's the way that rates break below the 200-day moving average. We'll see. We'll see what happens. And again, just as a reminder, the yield curve is fairly flat at this point, comparing the 3-month to the 10-year yield. All right, looking at Bitcoin, wanted to highlight that last week, Bitcoin did get below its 50-day moving average, that is on blue. The 200 days down here, right around 96,000. We're currently around 104,000, so we're back here. Now we did briefly go below 100,000. I don't have all of the, 100,000, 10,000 increments that is highlighted in blue, but I probably should, because Bitcoin often finds support or resistance at those 10,000 increments. So 100,000 per Bitcoin is right here. This was the swing low from earlier in June. This now appears to be a swing low for the last 24 hours. So keep an eye on that. I think holding 100,000 here could set us up for a nice upside reversal to retest the previous highs. The RSI for now holding the 40 level, which is overall pretty constructive. I think anything above the 200 is still pretty good, but breaking there would be a big negative. All right, let's look at a couple stocks. I just grabbed a couple beyond the ones that we talked about a little bit earlier, and then we'll take a question or two, and then we'll be done. Just want to point out on the chart of Alphabet how Fibonacci retracements have been pretty meaningful. Here is the February 2025 high, around $207. Here is the April 2025 low, right around $140. You can see the 38.2% retracements right around 166, and ended up being almost perfectly the peak in late April. We eventually made it above that peak in mid-June, and then subsequently the resistance became support. And that 38.2% level still important. When it broke above there, we got above the 200-day. We got almost exactly to the 61.8% level, which is around 181. We have now pulled back and are actively testing that 38.2% level. So the last time we were here, which was in early June, we held right around these levels, and now we've broken briefly down around $162. We're back right around and closed right at that 165 threshold. I'd love to see if that holds as a swing trader. This is the kind of thing where you see, all right, a pullback to the 50-day, to Fibonacci support, to an RSI of 40. Maybe we bet on a swing back up to retest the previous swing highs from mid-June. Could be a really good thing, but I would definitely be keeping stops relatively tight based on the fact that we're in an active downtrend. See if the RSI can hold 40. If we get much lower and the RSI breaks below 40, that's where I think you have to start to be concerned about further deterioration. On the bullish side, you really want to get back above 165 and hold it, and have a bounce off of those levels. So at a key point, again, as a swing trade, I think it's an interesting potential upside bounce there. Amgen not looking good yet. A couple of biotech names that got dinged pretty good today. We've been testing the 200-day moving average. That's what I wanted to highlight here. We had this nice rally off of the May low around 260, rallied up to $300 a share, and then rotated back down. We're actually trending downwards last week, getting back below the 200-day moving average. Today, we're really accelerating to the downside. The good news is we're getting down to a kind of a confluence of support. The last couple lows have all been down in the 260, 265 range. So I think if we get down to that range, again, my swing trader hat is thinking, ooh, maybe we bet on that support holding and maybe bet on a retest back to the 200-day moving average. So a couple names like this have had some, painful drops here while the market is remaining a little stronger. I'm wondering if that gives us an opportunity to buy in on a swing low of sorts. Oh, one more chart. I thought I grabbed the technology name in there. I did. Applied Materials, keeping it Fibonacci today because I missed Fibonacci day, 614. I always do some sort of special Fibonacci something, and then I was gone last week. So sorry, I kind of missed my window to do some sort of Fibonacci joke. So I'll make today's episode a little bit about it. Applied Materials, I would say a fascinating chart right now. There's so many things going on here that I want to share with you. So a couple things, right? If we look at the momentum divergences, here we've got higher highs in price. We can see weaker RSI. We're overbought over here. We are not overbought on the subsequent test. So that's a bearish momentum divergence. So Applied Materials doing a very similar thing to what we see on the chart of like the NASDAQ 100 and the S&P 500. Higher highs May into June on weaker momentum. Now, this just happens to be happening right at the Fibonacci resistance level. So if you take the July 24 high and the April 25 low, 38.2% of the way up is around $173. That was the peak from mid-May. That's now the peak that we established in June. It's kind of hard to see, but this is a dark cloud cover candle where you have a big up day, a down day, and day two gets at least 50% of the way through the body of day one. That's called a dark cloud cover. On the next retest of that Fibonacci level, and we've pulled back. So now we've got some bearish, indications from the bearish divergence and the failure at resistance, but we also have the 200-day moving average, which we're holding right now. So I think this is a crucial moment for Applied Materials. The bull case where we pull back to the 200-day and then resolve higher, good for semiconductors, good for the SMH, good for technology, good for the markets. If, however, this bearish divergence becomes more dominant and we rotate back below the 200-day and that does not hold and we can't get a foothold back above 175 this week, I think that's bad news for semiconductors, bad news for technology, bad news for the market. Applied Materials may be the chart to watch this week, I would say, from a technical perspective. Pretty key group, pretty key moment, some conflicting evidence. Let's see how this resolves. We'll certainly be keeping an eye on it this week. All right, those are the charts I wanted to review. I'll take a question or two, and we will be done. Hey, I will happily celebrate one of my podcast interviewees, Keith Fitzgerald. He's actually a fellow Seattle area resident. He's in a different part of the city, up in a beautiful area on the Puget Sound, which is absolutely stunning. And Keith is he's usually pretty bullish on technology and AI, and rightly. I mean, he's been right on those names for a while. So points for that. He is definitely. I saw some bullish comments from Keith on Tesla, and I won't go through all of his the nuances of his kind of bull case for those themes. But when I hear from Keith, it reminds me of the work of John Markman, who wrote a fantastic book. It's the kind of book I thought might be on here, but it's not, or I would show it to you. It's called Fast Forward Investing. It was written a number of years ago, but if you're struggling with themes like AI and robo taxis and just and just wondering how that should fit into your portfolio, I tend to think of those kind of things as long-term plays, right? These are the kind of things these are long-term themes that are probably going to work in a lot of ways, right? And I would bucket cryptocurrencies, nanotechnology, artificial intelligence, driverless vehicles, electric vehicles. Individual companies are going to have upswings and downswings when regulations change and when different economic forces shift. But the long-term argument for those companies is what Keith does a great job of articulating, I would argue. He's mentioned that on a number of times when I've interviewed him. Interviewed him earlier this year on my on the Market Misbehavior podcast. I would encourage you to check that one out. And I did see his comments pretty bullish on Tesla after the good results. So yeah, for sure. Yeah, Larry, and again, thanks for the super chat today. You mentioned, did you see the Direction Homebuilder ETF ticker nail? I mean, let's celebrate one of the great ETF tickers. There's someone, I think it's ETF.com or someone that does an annual award for like the best new ticker, because there's some creative ones. Nail is such a good one for a Homebuilder ETF. Those are up pretty good. And I would say there are times when, with some of these things, particularly when you're expecting some mean reversion in charts that have not been working and you think might start to work, whether or not you think they're a long-term play, If you think it's more of a swing trade, that's actually what some of those leveraged directional ETFs were designed to do. They weren't designed like a double leveraged home builder ETF. It wasn't really created with the intention of people holding them for longer periods of time. They were actually intended as shorter term bets for day trading and for making swing bets because you're betting on a big move happening in a short period of time. So that is one of those times where, again, assuming you manage your risk effectively, I would say, and you do your due diligence, that's really what some of those techniques were designed to capture. So I wouldn't have a problem if that's a bet you want to make, thinking of some of those leverage ETFs as one of the levers you can pull to get that sort of exposure. 100%. I think that's a perfect one. My name is Chuck. Thanks for watching on YouTube. As always, you mentioned the market seems to be in a permagrin mode. Yeah, 100%, right? And you can see, right? And when you see the news headlines over the weekend, I don't know about you, but my initial reaction is the markets are going to drop probably on Monday because people are going to be worried about, the U.S. being drawn into an extended conflict. Is it another Iraq, another Afghanistan, another like quagmire of, that so many here in the U.S. on both sides of the political spectrum seem to be generally opposed to? It's something that has not gone particularly well. It's not something I think many are eager to sort of, have happen again. Having said that, I mean, the market reaction overall has been, fairly constructive so far. Now, again, it's still early days, and I think we'll see what happens. We'll see how this sorts to evolve. But the market is certainly going higher on news that I would not describe as generally positive. Have the events there really impacted things on an economic side? No. So we'll see. I mean, what is happening? I mean, and again, this is speculation, and we'll wrap it up. One of the things I'm thinking about, I have a trip planned to the Middle East in the fall, in September and October. I am actively reconsidering whether that's something I'm comfortable doing, depending on what happens between now and then. And a lot of flights around Dubai and Doha have been canceled in the last 72 hours. Given what's happening here. So there are ways that this could have disruptive effects for economies. It's just still so, it's still relatively limited, and the scope of the impact has been interpreted to be relatively limited. We'll see. And at the end of the day, the markets are pricing in expectations. So for now, the markets are telling you expectations are going to be limited impact, and that things are still going to be fine, and that companies can still generate earnings despite what all is happening around us. We'll see how that continues, but we will be here with you every trading day, watching those charts evolve, reporting on key movements. Hopefully, some of the stocks we talk about today, you can monitor along with us this week, and we'll see which way they resolve. For now, though, I wish you a fantastic evening. Great to be back in Redmond, Washington. Great to be here with you. And I'm here to remind you, it is always a good time to own good charts. Have a good night, folks.